What happens when people start taking risks? Not because they're brave, but because someone else will clean up the mess. Imagine this, you're driving a brand new car. You know that if you crash it, someone else will pay for the repair. Would you drive carefully or would you take risks you normally wouldn't? This, right here, is the hidden danger called moral hazard. And today, we're going to break it down in the simplest way possible, with real-life stories, examples, and solutions you can relate to. Moral hazard doesn't mean someone is immoral. It's not about good or bad behavior. It's about risk and responsibility. It happens when people, or even entire companies, take more risks because they know they won't face all the consequences of their actions. In plain English, if someone else is paying for my mistakes, I'll be less careful. This idea first appeared in the insurance industry during the 18th and 19th centuries. For example, if a homeowner's house was insured against fire, they sometimes became careless about fire safety. Why worry when the insurance company would cover the losses? Over time, economists realized this idea wasn't just about houses or fires, it applies to money, banks, healthcare, workplaces, even everyday family life. A driver with full car insurance might speed up or park carelessly because they know someone else is covering the damage. Remember the 2008 global financial crisis? Big banks made huge risky bets on bad mortgages. Why? Because they believed governments would bail them out if things went wrong. They were right. Many got rescued. This meant banks kept the profits when they won, and taxpayers paid the bill when they lost. That's moral hazard at its biggest. When patients don't directly pay for their full medical cost, they may overuse services, multiple tests, unnecessary checkups, and doctors sometimes order extra procedures, knowing they won't pay the bill either. Think about an employee who knows mistakes won't cost them personally, but will cost the company. They may not put in their best effort. A teenager driving a parent's car recklessly because, "It's not mine, Dad will fix it if it breaks." That's moral hazard in action at home. The real problem is this. Decision-making and responsibility are separated. The risk shifts to someone else. The reward stays with the person taking the risk. And when that happens, reckless behavior grows, sometimes small, sometimes catastrophic. Moral hazard isn't just theory. It has consequences that affect all of us. It encourages reckless lending, like banks giving loans they know might fail. It causes financial crises, just like in 2008. It wastes resources in healthcare systems. And worst of all, it erodes trust in companies, governments, and markets. As Nobel Prize-winning economist Paul Krugman said, if financial institutions are shielded from the consequences of their mistakes, they will be encouraged to make the same mistakes again. And Warren Buffett was even sharper. If you bail someone out, you've taught them that if they gamble and lose, we'll cover it. But moral hazard isn't unbeatable. There are solutions. Skin in the game. People make smarter choices when they share the downside. For example, bank executives could be required to hold personal stakes in their company, so if the company fails, they lose too. Contracts and incentives, insurance companies add deductibles or co-payments. This makes people think twice before being careless. Transparency and monitoring. In workplaces, performance checks and oversight keep employees accountable. Stronger regulations. Governments can design rules to prevent excessive risks by banks, insurers, and corporations. Here's why moral hazard still matters today. Climate change. If polluters think governments will always clean up, they'll pollute more. Student loans. If universities know students can borrow easily, they'll keep raising tuition. Tech companies. If firms only pay small fines for privacy violations, they'll continue risking user data. Moral hazard shapes modern decisions in ways most people don't even see. So, what's the lesson here? Moral hazard explains why people and organizations take bigger risks when they're protected from failure. It reminds us that even systems created with good intentions like insurance or bailouts can unintentionally create reckless behavior. The real solution isn't to remove support but to share responsibility fairly. Because in the end, the question is simple. Should one person enjoy the reward while another person pays the price? That's the challenge of moral hazard, and it affects every one of us.